So, all right, yeah, this is the seventh episode of the series on stock market basics, and in this episode, we'll be looking at share classes. We will consider a common stock and a preference stock. Remember, they are all shares or stocks of a company, and they give their holders ownership right to the company. Just that common stock differ from preference stock in a way that with common stock, the holders are not entitled to a known sum of dividend. That is one. And also, they are last in queue during settlement in a liquidation process. That is, preference shareholders take priority over common stockholders in the event of the company being wind up. Yes, and on the other hand, common stockholders have the advantage of full voting rights in the company. They also get more in when the company is in good time. That is, after all liabilities of the company have been met, including paying preference shareholders their dividend. Common stockholders take the residue, from the company. So when the company is performing, common stockholders enjoy more than the preference stockholders. But then in bad time, preference stockholders seems to be in advantageous position as against common stockholders. Preference share is a combination of debt and equity. That is their characteristics, because preference stockholders receive a fixed income, annual fixed income, and aside that, they do not have voting rights in the company, with the exception of some few circumstances when they have outstanding dividend to be paid to them. Yes, and preference shares can also be cumulative. That is, when a company fails to pay dividend in a particular year, the liability of the company to pay shareholders their dividend accumulate, so that it is paid when the company, during the year that the company is making profit, and they are able to redeem those dividends. And it can also be non-cumulative. That is, the dividend do not accumulate. If the company is not able to pay for a particular year, preference shareholders forfeit the dividend. They can also be participatory preference shares. That is when preference shareholders participate in the company activities, that is, have voting right, redeemable, irredeemable. Yes, but during the they enjoy seniority. Preference shareholders enjoy seniority over common stockholders when the company is being wind up. Yes, but then they also are in a disadvantageous position when the company has made so much profit, because the residue after paying preference shareholders goes to the common stockholders. So that is the disadvantage to common stockholders. But if you are in for lower risks, then preference shareholders holding rights is yours. But if you are ready to assume full risks so that you can enjoy from the good time and suffer the bad time, then common shares is also what you should be considering. Yes, this brings us to the end of this episode. In the next episode, we'll look at regulation, stock market regulation. Let's understand how the stock